Hey everyone, and welcome to today's edition of The Rundown. So we figured a good place to start today was talking about this divergence we've seen between the markets and the economy. We've seen a rally in the markets off the lows back in March of about 30%. But at the same time, we're seeing some pretty bad economic data come out. So let's set the stage there. The big thing that we're focusing on, or the one thing that's not we're necessarily focusing on, but the one thing that's getting a lot of attention is that unemployment number. In April it was 14.7%. Normal, good economic times, 3.5 to 4.5% unemployment. That's what you want to see. So we're talking about, Depression era type figures. We're also seeing, a decline in GDP. We're seeing bad retail numbers that just came out last week. We're seeing some pretty, not the greatest manufacturing numbers. There's a lot of different areas of the economy that we're seeing some bad numbers. So the first question would be, okay, well, why is the market rallying if we're seeing such bad numbers? Well, one thing we got to keep in mind is this economic situation wasn't the bubbling up of something that was, a problem in financial markets or a problem that was an undertone in the economy that all of a sudden there was enough going on that caused this to happen. This was an outside circumstance, so the virus, that came in and forced this shutdown. So it was a forced shutdown of these different areas of the market. So the market, in essence, is factoring that in and largely has expected to see some of these poor numbers come out, and quite frankly is probably expecting to see these numbers continue at least for the short term, because the one thing we need to remember is the market is what we call a discounting mechanism. Basically factor in as much of the information as possible to figure out where we're at. What should things look like, say 6 to 9 months down the road? So a snapshot in time of the progress that could be made on everything that we have going on right now. So if it's thinking 6 to 9 months down the road, we're saying that it's expecting these poor numbers to come out, but there's going to be a recovery. It's just a matter of time till we get a recovery. So it's in large part just kind of shying away from factoring those numbers in. That said, we did factor those numbers in back in March. Now we've recovered since then. That's a piece of it. Really, there's a few different things that we think explains how much it's rallied since those March lows. And obviously the first one is progress around the virus. Flattening of the curve in a lot of different states. Obviously the virus is a whole topic in and of itself. But advances in some of these therapies and potentially some vaccines that might be coming out soon. Those are all good things, good tailwinds for the market, because it basically means we're making progress on combating the virus. Because at the end of the day, that's what caused all of this to start happening. So the quicker we can get back, the quicker we can recover, so the quicker we can get ahead of the virus, the quicker the economy can recover. The other thing too is the Federal Reserve. The Fed has basically said we're taking the gloves off and we're going to throw everything at the economy. So, they cut interest rates, they started buying bonds, which helps prevent companies from defaulting and bankruptcies. There's a whole other subject there, but basically props up a lot of these companies that are struggling, which, if it's propping up the economy, it also props up the market a little bit. And then the third thing is, with the Federal Reserve at least, is with interest rates being said they're going to stay low, that's very friendly of an environment for stocks. Low interest rates is very friendly for stocks. So that's another piece. A third piece is we're getting the economy reopened. So you're starting to see some people get back to work. You're starting to see that at least the intention of getting people back out there and getting people to spend. Because, online sales is only a sliver of what's going on. I'm sure, like myself, you've been buying as much as you can from Amazon, but that's only a sliver of what's going on in the market. So we need people to go back out and spend, because there are so many depressed companies that are just not seeing revenues right now. Hence why you're seeing, these PPP loans. You're seeing some of this support from the Fed. You're also seeing some of that fiscal stimulus that's putting money in people's pockets to float people through this situation so that they can get back out there and spend. Essentially what's going on is we're trying to float people as long as possible in hopes that we can make enough advance to combat the virus so people get right back out and spend, and in theory get back to right where we were before all of this happened. Because we were, from all the data, we were in a really good economic situation prior to this. So the intention is to make this almost a stopgap and make it as short as possible to get back to that point. And then the last thing, which is a little bit more specific to individual stocks and companies, are you're seeing these indexes be lifted primarily by larger tech firms. So these larger companies, and by larger I mean you've got the S&P 500, it's weighted based on size of a company. So an Apple and an Amazon make up a much larger portion of the index. So they're doing pretty well in this environment. Granted, there's stocks that are doing really poorly still, but because they're doing so well, it's kind of lifting, a rising tide lifts all boats. It's really lifting the entire index up. That's kind of a mini divergence. That can't go on forever either, but it's certainly helping to boost this rally. There's other little things too. There's a fear of missing out, but really, I think, and we think at the end of the day, it just points to the fact that the markets are still volatile. The markets certainly are still fragile. And we think that there's still a fair amount of uncertainty. If we get bad news, we'll probably see some small sell-offs. If we get great news, we'll probably see some big rallies. So if you have all that volatility, to us it means now more than ever, it's really important to develop a strategy, make sure what's happening in the markets isn't impacting your financial plan, and make sure that your investments are aligned properly to your goals and your risk. Because if you can keep focus on that and you can prevent yourself from making rash, emotional decisions from an investment standpoint, you should over time still be able to meet those long-term goals. So we're saying now's a time for patience. It's a time to be very disciplined and stick to a sound strategy to get you beyond what's happening now, and get you to still meet those long-term goals. So hopefully that shed a little bit of light on what we think is going on in the markets, why we're seeing this rally versus these poor economic numbers. And we hope to continue to do a lot more of these and bring these to you. So thanks so much for tuning in. Stay safe, be smart out there, and we hope to see you again real soon.